Navigating the complex landscape of personal finance requires a deep understanding of the hidden pitfalls that can quietly dismantle your hard earned progress. The journey to true financial freedom is not just about how much you accumulate, but how effectively you protect your capital from systemic risks. The absolute first trap you will inevitably encounter on this path is overconcentration. This phenomenon occurs when an investor holds an excessive amount of their total wealth within a single asset or company. In professional wealth management, this risk is traditionally triggered whenever any individual stock or standalone investment commands more than 10% of your aggregate portfolio value. When you pass this specific threshold, you are no longer participating in a balanced investment strategy. Instead, you are actively wagering your entire financial stability on one isolated outcome, leaving your future completely dependent on the operational success of a single corporate entity. To illustrate this clearly, imagine managing a total portfolio worth $200,000, but keeping $100,000 of that capital completely tied up in Apple stock. If that business faces unexpected regulatory hurdles or market disruption, your entire financial trajectory takes a direct hit. For a powerful historical warning, look at Intel during the peak of the dot-com era, when it traded at an all-time high near $65 per share. Anyone who concentrated their wealth into the company back then would still be waiting to break even decades later, missing out entirely on the broader market's expansion. In stark contrast, the S&P 500 index has multiplied by more than 5 times over that identical time horizon. What we should strive for is sustainable, compounded expansion without exposing ourselves to catastrophic failure. Overconcentration shatters objectivity, causing investors to form intense emotional attachments to single holdings, which completely derails rational decision-making. Most institutional wealth advisors recommend keeping any single security below 5 to 10% of your total net worth to ensure maximum resilience. While protecting your portfolio against asset concentration is essential, how you handle your daily outflows is equally critical to long-term wealth preservation. This transitions us perfectly into the second major pitfall, which is lifestyle creep. This insidious financial trap quietly drains your wealth-building potential as your everyday operational expenses automatically expand alongside every increase in your income. It is an incredibly widespread phenomenon that acts as a primary barrier to economic freedom. When people experience career growth, their default instinct is often to immediately upgrade their surroundings, vehicles, and social habits, effectively neutralizing the wealth-building power of a higher salary. Instead of allocating the surplus cash flow into income-generating assets that compound over time, the extra earnings are instantly absorbed by higher recurring liabilities. This cycle locks individuals into a continuous loop where they must work harder just to sustain an increasingly expensive lifestyle, ensuring they remain financially stagnant despite earning more. To comprehend the sheer magnitude of this issue, analyze a comprehensive survey compiled by Goldman Sachs detailing the percentage of professionals currently living paycheck to paycheck. Among workers earning under $50,000 annually, a significant 57% report completely exhausting their funds every month. However, the data becomes truly staggering as you ascend into elite income brackets. 41% of individuals making over $300,000 a year admit they still live paycheck to paycheck, and an astonishing 40% of households pulling in more than $500,000 annually echo this exact same struggle. This proves that high earnings mean nothing without disciplined capital management. Real affluent progress is achieved by maintaining a modest, intentionally structured lifestyle while your income grows rapidly. This core philosophy was famously documented in The Millionaire Next Door, where research proved that the most efficient accumulators of wealth intentionally froze their spending patterns, even during massive salary surges. True life satisfaction is anchored in memorable experiences and relationships rather than accumulating material possessions. Beyond the psychological traps of spending, structural efficiency inside your financial architecture represents the third trap you must actively master, which is tax inefficiency. While discussing tax optimization might seem dry, taxes undeniably represent the single largest ongoing lifetime expenditure you will ever face. It consistently outpaces your housing costs, vehicle debts, and general lifestyle maintenance combined. Failing to approach this strategically means you are willingly leaving massive sums of money on the table, money that could otherwise be fueling your compounding investment engine. The most frequent errors involve completely ignoring modern tax minimization strategies, utilizing the incorrect structural accounts for specific asset classes, and fundamentally miscalculating the heavy toll that capital gains liabilities will extract upon liquidation. When you operate without a clear tax framework, you significantly erode your net returns, making your journey to sustainable wealth far more difficult than it needs to be. A major tactical blunder is placing high-yield dividend stocks inside standard taxable brokerage accounts, rather than utilizing specialized tax-sheltered structures, like an individual retirement account. By doing this, you trigger an immediate tax liability every single time a dividend is distributed, severely interrupting the compounding process. To combat this inefficiency, highly successful investors aggressively maximize their contributions to qualified retirement vehicles and health savings accounts. Furthermore, holding quality equity positions for longer than a 12-month duration shifts your status into long-term capital gains brackets, which carry drastically lower rates. You must also leverage tax loss harvesting by deliberately realizing strategic losses to completely offset your capital gains, heavily reducing your year-end financial obligations to the state. The authorities will always demand their regulatory share, but your professional mandate is to ensure you never pay a single dollar more than legally required. Just as structural discipline is required to navigate fiscal liabilities, maintaining absolute awareness of your debt obligations forms the foundation of our fourth trap, which is being completely lazy about refinancing. Countless asset owners leave substantial monthly savings on the table simply because they refuse to actively monitor shifts in macroeconomic interest rates. In real estate debt management, a standard operational benchmark is that a 1% decline in prevailing market interest rates serves as the definitive trigger point where evaluating a total refinance becomes mathematically compelling. When macroeconomic shifts lower the cost of capital, clinging to an outdated loan structure acts as a severe drag on your cash flow. Refinancing requires upfront effort and evaluating closing costs, but ignoring these market adjustments can cost you hundreds of thousands of dollars over the lifetime of a standard loan. Remaining proactive means treating your liabilities as dynamic instruments that must be constantly optimized. To evaluate the exact financial mechanics, let us explore a scenario involving a $600,000 mortgage balance on a residential property valued at $750,000. If your initial contract locked in an interest rate of 7%, your fixed monthly obligation sits at approximately $3,992. By actively refinancing that debt down to a current market rate of 6%, your new monthly payment drops down to $3,597, resulting in an immediate savings of $395 every single month. Assuming standard institutional closing and restructuring fees total 2% of the loan amount, your upfront transaction cost equals $12,000. Dividing that $12,000 expense by your monthly savings reveals a clear break-even timeline of roughly 30 months. Therefore, if you definitively plan to retain ownership of the asset for the next 5 to 7 years, executing this adjustment is highly logical. However, if a relocation is on your horizon within the next year or two, absorbing those upfront restructuring fees lacks any mathematical justification. While our previous discussions have centered heavily around fiscal metrics and structural portfolios, the fifth trap on our list pivots away from capital completely, targeting an asset that is completely irreplaceable: your limited time. One of the most tragic paradoxes of wealth generation is that high-achieving individuals frequently trap themselves in a state of perpetual overworking. This is not merely a financial misalignment, it is a profound threat to your psychological stability and overall well-being. As your aggregate net worth expands, the mathematical reality of your financial situation shifts dramatically. Your accumulated capital begins to generate far more economic output than your physical labor ever could. At this critical evolutionary stage, your time becomes exponentially more valuable than earning another linear hourly wage. Failing to recognize this shift causes successful professionals to continue trading their finite energy for incremental dollars, completely missing the freedom that their capital was supposed to buy them. To ground this concept with a mathematical model, consider a portfolio that has grown to a substantial $8 million. Even when deployed into highly conservative income investments yielding a modest 5% annually, this capital effortlessly generates a massive $400,000 every single year, without requiring a single hour of physical exertion. Broken down into a daily time frame, that equates to roughly $1,096 accumulating in your accounts every 24 hours. When your money is generating over $1,000 a day automatically, continuing to sacrifice your personal life for marginal professional earnings experiences severe diminishing returns. Kyle Invests focuses on building authentic wealth to achieve true freedom, which means we must actively evaluate our priorities. Are you using your money to buy back your life, or are you still trapped on the treadmill? Let me know in the comments below. At what net worth milestone will you finally prioritize time over an extra dollar? If you find this perspective valuable, take a quick second to hit that like button and subscribe to the channel right now. Now, let's shift gears from managing your time to managing your ego, which brings us to trap number 6, overconfidence driven by early success. This is an incredibly dangerous psychological pitfall that targets people who experience rapid financial wins early in their journey. When everything you touch turns to gold, it is dangerously easy to confuse a raging bull market with your own sheer financial genius. Let me give you a hypothetical scenario. Imagine a newer investor named Julian who decides to build a highly concentrated portfolio of just 12 growth stocks. That strategy is already risky, but during a massive market run-up, let's say 10 of those 12 picks absolutely skyrocket. His portfolio value explodes, and suddenly Julian believes he has completely cracked the code to Wall Street. Instead of securing his profits and diversifying, his overconfidence pushes him to double down. He takes those 12 stocks and condenses them into just 4 highly volatile tech plays. Convinced he can predict their next earnings reports, he even starts trading on margin, borrowing money to amplify his aggressive bets. The inevitable result of that unchecked arrogance is usually a devastating financial collapse. When the market inevitably corrects itself, highly leveraged and heavily concentrated portfolios are the very first to get wiped out. In Julian's case, a slight downturn in the tech sector could completely decimate his holdings, leaving him with a massive deficit while the broader S&P 500 might only be down a few percentage points. The hard, unbiased truth is that a hot streak lasting 2 or 3 years does not make you a legendary investor. It usually just means you got lucky at the right time. Statistically speaking, over 90% of active day traders fail to consistently beat the market over a long-term horizon. If you are sitting on massive gains from a few lucky trades, the smartest move you can make is to secure that capital, check your ego at the door, and transition into a sustainable long-term indexing strategy. Do not let temporary market exuberance trick you into playing a game where the mathematical odds are overwhelmingly stacked against you. Trap number 7 sneaks up on you as your net worth expands, and that is allowing your financial ecosystem to become entirely too complex. When you first start building wealth, your setup is usually incredibly simple. One checking account, a standard savings fund, and maybe a basic retirement portfolio. But as your income aggressively scales, the temptation to diversify into exotic vehicles grows exponentially. Suddenly, you might find yourself managing 3 different brokerage platforms, a handful of fragmented crypto wallets, random angel investments in startups, and a convoluted real estate syndication deal. The core issue here is that this sprawling financial complexity actively creates massive blind spots in your wealth building strategy. When you have too many moving parts, it becomes ridiculously easy to overlook hidden management fees, severely miscalculate your overlapping risk exposure, or simply lose track of where your capital is actually deployed. Sophistication does not equal profitability. To highlight how widespread this issue is, financial industry surveys reveal a fascinating psychological quirk among the wealthy. A massive percentage of high net worth individuals openly admit that they frequently pretend to understand complex investment vehicles just to avoid looking uneducated in front of their peers or advisors. They nod along to pitches about intricate tax-advantaged syndications or leveraged private equity funds without fully grasping the underlying mechanics of what they are actually buying. If you cannot explain exactly how an investment generates its return within 60 seconds, you have absolutely no business putting your hard-earned capital into it. As your portfolio crosses into the mid-6-figure or 7-figure range, structural simplicity and clear visibility become your greatest assets. If your financial life feels like an untamed jungle, that is the exact moment you need to step back, aggressively consolidate your accounts, and potentially hire a fiduciary advisor to help streamline your entire operation. This brings us directly to trap number 8, which is getting caught in the dangerous position of being asset rich but cash poor. This is a severe liquidity crisis that happens when the absolute vast majority of your total net worth is locked away in highly illiquid vehicles. On a standard financial spreadsheet, you might look like an absolute millionaire, but if a legitimate emergency strikes or a massive investment opportunity presents itself, you cannot actually access a single dollar of that wealth. A shocking number of modern millionaires have their entire net worth completely trapped inside the equity of their primary residence and highly restricted retirement accounts. You cannot go to the grocery store and pay with a brick from your house, and you certainly cannot liquidate a piece of your home in 48 hours to fund a lucrative new business venture. When your wealth is entirely illiquid, you completely lose your financial agility, leaving you highly vulnerable to sudden cash flow interruptions. To defend against this exact trap, you must build and maintain a fortress of accessible liquidity. The standard foundational rule is keeping at least 3 to 6 months of baseline living expenses in a high-yield, perfectly liquid savings account. However, if you are actively scaling your net worth, operating a business, or hunting for the next big market correction to deploy capital, you should seriously consider holding an even larger strategic cash reserve. Furthermore, before you lock your money into any long-term asset, you must brutally evaluate your upcoming time horizon. If there is even a slight chance that you will need that specific capital within the next 2 to 3 years, committing it to an illiquid real estate deal or a locked-in partnership is a catastrophic mistake. Strategic liquidity is not just a defensive shield against unexpected emergencies. It is the ultimate offensive weapon that allows you to buy premium assets at a steep discount when everyone else is scrambling for cash. Trap number 9 is arguably the most common and destructive pitfall of all: delaying your retirement savings because you falsely believe you have plenty of time. Human beings are fundamentally wired to procrastinate, always telling ourselves that we will start taking our investments seriously next year, after the next promotion, or when things finally settle down. But in the world of compounding interest, time is infinitely more valuable than the actual dollar amount you contribute. Let's look at a mathematical reality check. If you start investing a flat $5,000 every single year at an 8% annual return starting at age 22, your money has decades to aggressively multiply. If another investor waits until age 32 to start executing that exact same $5,000 annual strategy, they will cross the finish line at age 65, with essentially half the wealth of the early starter. Waiting just 10 years completely decimates the explosive exponential power of the compounding curve. Even if you feel like you are getting a late start, the absolute worst thing you can do is continue to delay. The best time to plant a tree was 20 years ago, but the second best time is right this exact second. To completely neutralize this trap, you need to follow a ruthlessly simple operational blueprint. First, aggressively eliminate high-interest consumer debt. Second, rigidly lock in your current standard of living to prevent lifestyle creep. And finally, the ultimate wealth-building cheat code. Commit to saving at least 50% of every single raise or bonus you ever receive for the rest of your career. If your annual salary jumps by $20,000, you immediately route $10,000 of that new money directly into your investment accounts before you ever see it in your checking balance. This brilliant psychological trick allows you to genuinely enjoy a better lifestyle with the remaining half, while simultaneously supercharging your retirement portfolio without feeling any sense of sacrifice or budget restriction. The 10th and final trap we must address today is leaving your empire completely unprotected by being severely underinsured. If you are diligently executing all the strategies we discussed, you are well on your way to amassing significant wealth. However, building that wealth is only half the battle. The other half is constructing an impenetrable legal and financial wall around it, so you never lose it. As your net worth scales upward, you automatically become a much larger, highly visible target for devastating lawsuits, unexpected medical catastrophes, or catastrophic property loss. The basic insurance policies that protected you when you were broke are fundamentally useless when you have real assets on the line. Home values appreciate rapidly and replacement costs surge over time. If a disaster strikes and your coverage limits are still anchored to what your property was worth 5 years ago, you will be forced to liquidate your hard-earned investment portfolios just to rebuild your life from scratch. To effectively combat this exposure, You need to establish a non negotiable annual wealth defense day on your personal calendar. Once a year, sit down and aggressively audit your entire insurance framework. Verify that the stated replacement value of your home perfectly matches current market realities. Ensure your auto limits reflect your current exposure. And most importantly, secure a massive personal umbrella liability policy to shield your total net worth from targeted litigation. Protecting your downside is the ultimate mark of a sophisticated investor. Thanks for watching. If you enjoyed this video, don't forget to like and subscribe. And before you go, let me know in the comments below. At what exact net worth milestone do you plan to finally prioritize your time and freedom over chasing that next extra dollar? I'd love to read your strategies. See you in the next video, and remember, stay smart with your money. Take care.